I wanted to thank everyone for attending the Place Your Trades Network Spaces to discuss energy and agriculture. This Spaces is brought to you by TraderVate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now also trade these on the DOM on TraderVate's main platform as well. It's a great way to get exposures to the futures market with limited risk. You can use the link in my Twitter stream to go and get the TraderVate app for free. I also write a weekly blog and daily pre-market overview on markets that you can subscribe to at placeyourtrades.com. It's free, just sign up. And then I also will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. So if you're interested in getting this PDF, go ahead and click on the link that I just put out, and I'll put it up in the nest too, that I just put out on Twitter. You can sign up for that there. I'll put this in the nest in just a minute. And this will be available and mailed out tomorrow to anyone who signs up. Now, I'd like to introduce our guests. First, we have Andrei Sizov. I hope I said that right. Andrei is head of Sov Econ, which is a think tank, and editor of the Sizov Report. Can you mute yourself, Chris? Sorry, we're getting a lot of feedback. Is a think tank and editor of the Sizov Report on Black Sea grain. They help their clients to trade better and avoid costly mistakes by providing analysis of the important and volatile Black Sea region. So if you're trading grains and especially wheat, you might want to go check out their service with a free trial at Sizov.report.com. You can also go to his Twitter handle, and he's got a link there in his bio. Just last week, they predicted that grain deal would be terminated by Russia, so they're on top of their game. Next, we have MaleehaMBCC, which I hope she gets up here. Graduated from Cornell University with a Bachelor of Science degree in engineering in 1997. From 97 to 2012, she worked as a portfolio manager trader for various hedge funds and proprietary trading desks. She started her career at UBS O'Connor, a global multi-strategy hedge fund, where she gained experience across a host of trading strategies and asset classes. She then went on to work for Goldman Sachs, J. Aron, Merrill Lynch Commodities, and Noble Group. In 2015, she launched MB Commodities Capital that focuses on using a top-down macro and bottoms-up fundamental relative value analysis, applying cross-asset arbitrage techniques to capitalize on relative mispricings evident across these asset classes. And last but not least, we have Chris Stevens, journalist extraordinaire, currently freelance for The Guardian and petroleum economist. He's former Guardian correspondent for Libya, Tunisia, Bosnia, and Romania, former Scotsman correspondent, USA, former Scotsman Irish Times correspondent, Russia. He's also a noted author. His book is Judgment Day, The Trial of I can't say it. I can't pronounce that, and Atlantic Books. All right, I will get started. I want to start because we just had Russia just ended this grain deal, first and foremost on kind of everybody's radar right now. So I want to start with Andrei. And this Russia grain agreement was brokered by Turkey and the UN back in 2022. After several extensions, they have now decided to remove themselves from the offer. So for those that might not be familiar with this agreement, can you give us some background on this deal and what it entails?
Sure. So around a year ago, Russia, Turkey, Ukraine, and the UN as a witness, they made a deal, so-called deal, which actually is not a deal. It's just journalist myth that it's a deal. So that agreement, very simple, that Russia wouldn't mess with Ukrainian exports from Odessa region That's one of the key regions for Ukrainian grain exports. Won't attack vessels, won't attack grain infrastructure. And at the same time, the Joint Commission in the Bosphorus, the strait connecting Black Sea to the rest of the world, there will be a joint committee that will be expecting vessels going back and forth to make sure that there is only grain there or the food, no weapons, for example. So it helped a lot Ukraine because Ukraine needed that deal badly at that time, shortly after the start of the war, for several reasons. The first one was and still is that Ukraine badly needs hard currency to finance its inputs and to keep its economy afloat. And the second one, that in February 2022, when the war started, Ukraine still had huge stocks, grain stocks, after a record crop in 2021. So lots of stocks, all major terminals were blocked at that time. So the agreement, Black Sea Initiative, was a lifesaver for Ukraine. Does it make sense? Any additional comments, questions?
No, I think that's good. And so, what was Russia demanding that wasn't met this time around in these negotiations on extending this deal?
So again, yeah, and that's why I stressed that it's not a deal. So basically, I described what was, I've read it myself many times, and I always remember it. What was written in that document, only 2 pages, and I described it to you. In that document, there were no strict and there were no obligations by other party to somehow fulfill any Russian demands, whether it's let's name them a reconnection or to the SWIFT banking banking system, to one of Russian state banks, Russian agricultural bank, or whether it's reopening of the ammonia pipeline, which goes from Russia to Odessa as well, or whether it's some kind of lowering insurance for vessels going to the Black Sea to Russian terminals. None of that was in that Black Sea Initiative document. So it wasn't a deal, clearly. At the same time, Russia did sign another document, 3 years document, Memorandum of Understanding between Russia and the UN, that Russia would mess with Ukrainian exports. Russia would continue to ship its own food and fertilizer, and at the same time, the UN would try to lower barriers globally for Russian food and fertilizer. But obviously, we understand that it's not in the UN power to somehow magically reconnect Russian banks to the SWIFT, or to open, for example, Baltic ports for Russian ammonia, or to reopen the ammonia pipeline. And it was called not an agreement, but just a memorandum of understanding. So just quite vague document. Later, Russia mixed it all together, that was the first agreement and the long agreement, and said, yes, now that's our demands. And it was written that you have to fulfill them. And if you don't fulfill them, we will not terminate or not extend the deal. And they've been talking about that for almost a year. They extended that deal for many times. And that's why the market didn't believe that the deal is over this time. And this week we saw a sharp sell-off in wheat, or on Monday, for example. But things started to change this time, and they indeed terminated the deal, or at least put it on hold.
Okay, and then so I guess the last ship to sail under the deal left the country's Black Sea port of Odessa like a day before, I believe, the extension deadline was over. So, all right, does that mean effectively that exports are at zero right now?
Exports from Odessa, new exports are at zero right now. Obviously, no one is ready to buy anything at FOB Odessa. But it's important to add, and I mean, people are missing this right now, that Odessa terminals are not the only terminals that Ukraine can use, not the only way Ukraine can use and actually is using to export its grains. There are other ways as well. And so Odessa terminal, Kyiv will insist, will try to somehow reopen them. But in reality, they can do almost all the export program for the new season, which just has started for grains in July. They almost can fulfill the export program even without Odessa, even if the Odessa terminals are blocked.
All right. So let's put that on hold, and we'll come back to this. I want to go to Chris because we also just had Shahara and oil fields go down in Libya last week over protests. So can you kind of walk us through exactly what happened here? What were the details, and is this likely to occur again?
Thanks. Yeah. Well, I'd like to walk you through the kind of background. At the moment, there's a boom in the Libyan oil sector. There's been nothing like it since the revolution. Really, is like 12 years ago. There's a flood of foreign companies piling in. There's no new developments, but they're fixing the four Ps: the pumps, the pipelines, power supply, and ports. The actual production stays about 1.1 to 1.2, but it's a boom time for small and medium-sized companies. The problem is it's been financed with money that they just can't keep spending. The Tripoli, for sort of background, Libya spent about $10 billion a year in the first decade after the revolution. Then in 2021, that jumped to 17 billion, and then last year it jumped to 32 billion. So it's a threefold increase in public spending. The problem is there isn't the revenue to pay for it. That oil is about $20 billion a year, and in fact this year it's going to go down to 14 billion for income. So the difference is made up from foreign reserves. They're basically taking about $10 billion a year. They've got about 80 billion in the bank, plus another 70 billion from their sovereign wealth fund that's been frozen by the UN since 2011. So from the government's point of view, they say, well, we can keep spending an extra $10 billion a year for 15 years before we run out of cash. For the oil industry, one of the reason for this growth is that after they changed the chief of the NOC last year, they had an emergency budget of about $7 billion. And there's poured money everywhere. There are new gas-fired power stations. Everything has been fixed. Equipment that's been deteriorating for 10, 20 years is all being fixed. And I believe that people like Halliburton and Schlumberger, who are owed a lot of money, they've all been paid what they're owed. The other interesting thing is it's brought a sort of peace. You actually have foreign workers back. You've got Germans, Italians, Spanish, and various other nationalities are working there. Security is minimal. The sort of terror threat's gone away, and the militias, although very powerful, are behaving themselves. So for the moment, they're sort of making hay while the sun shines. The problem is, as mentioned, they don't have the money to keep doing this. And the other trouble is the production is not going up. Now, this year, as in every year since 2015, the NOC says we want to get production from 1.1 to 2 million barrels a day. They've been saying it literally since 2015, but they never explain where that's going to come from. And if I can push the Petroleum Economist map that we produced, this Libya map, when I sit with oil people and we look around the map, and we think, well, where's this extra production going to come from? There's a couple of areas. There's Gadames down in the southwest, which is a BP Eni concession that they've been talking about for years. There'll be something down there. There's also Waha in the east, which is this field that Total bought into. They think they can double production from 300,000 barrels a day to 600,000. But once you're finished with that, there's nothing else. There are no new developments. There's no magical field waiting to be fixed, and all this money that's going in at the moment is going in just to basically keep production where it is, and that's where the problem's going to be. Now the other problem is that Libya is very factionalized. There are two governments, and there's a host of militias and tribes and factions, and really no matter how much money you shell out, it's never going to be enough. And that was part of the reason for this shutdown. The shutdown came because a guy called Faraj Boutari, who's a member of the Zouai tribe, and who was a former finance minister, he was kidnapped basically by a government militia when he arrived back in Tripoli airport last week, and then spirited away. He wasn't actually arrested. He just vanished. So the tribe pushed the only button they had, which is to shut down oil fields. And what was interesting about the shutdown it was done in what one of the guys said to me is a very civilized way. They said to them, look, we're not going to come in and wreck anything. We're just telling you to shut down. So El Feel, Sharara, and part of Saria in the east did so. But the Sharara guys, the engineers said, look, can you let us keep a bit of oil going through the pipes? Because if we have a total shutdown, that gums up hundreds of miles of pipe and it's going to be a nightmare. So the tribe said, fine, yeah, we'll let you do that. Now, Sharara were in the process of shutting down when this guy was released. The government immediately caved in and released him and had a statement saying, actually, it was a big mistake. He's not charged with anything, etc., etc., etc. And I think what this has shown partly is how weak the government is. This government of Ali Dbeiba was brought in to supervise elections 2 years ago. The elections never happened. They were cancelled. And Dbeiba decided to stay in power. And the reason he's in power is because he's able to put out all this money. But the question is going to be, is even this enough money? Now, he's had apparently a clash with the NOC chief, Bengara, because although the NOC got 7 billion last year, they want another 5 billion this year. Now, it's not clear where that 7 billion went to, and there's no figures provided, and it's not clear why they need another 5 billion. But anyway, it doesn't sound like he's going to get it. And now we have the prospect of a much wider shutdown in August from Khalifa Haftar, the eastern warlord. Now, he's allied with the eastern government, which is in sort of Benghazi, Tobruk. Now, he officially says that the reason he wants the shutdown is because there's not enough transparency, which is true. No one really knows where this money's going. But the implication is that not enough of the money is going to eastern Libya. Now, whether that's true or not is impossible to say because there are no figures. So you don't really know whether it's true or not. Is there going to be transparency? Probably not. But if this shutdown happens, if it's a real thing, that's going to take 2/3 of production out of Libya. It's a familiar thing for the last 10 years that there have been these shutdowns. I mean, there were basically from 2013 to 16, there was almost no production. So it's a very real threat. But it may also be a bargaining tactic. He may be saying, look, there's all this oil cash flying around and my allies want more of it. So that's really where we are. It's definitely a boom time. If you're a small or medium-sized company and you're in Libya, you're making great money. But how long that's going to last, I don't know. And the majors are staying well clear. There's no new exploration. The only major that's had a move has been ENI, who have opened this gas field off Tripoli, but even they aren't going on land. And just the final thing to mention is that pressure may come from America and Europe on Haftar not to do the shutdown, because the thing that's changed in Libya basically has been Ukraine and the European Union suddenly needing to find new gas and new oil. And it's been a boon for everybody in the Mediterranean, for Algeria, for the East Med, for everybody, including Libya. With that comes pressure that the Americans particularly, the one thing they want is oil on the world market. They don't want it shut down for any reason. So Haftar may get some pressure through the Americans, through the UAE and Egypt, his allies, not to do this shutdown. So I think it's no more than a 50-50 that will happen. So I hope that illuminates a little bit.
Yes, absolutely. It's Libya is always got a lot going on.
It's eccentric,
right?
for sure.
Absolutely. So, what do you, I was gonna, that's kind of what I was going to ask is kind of you did mention ENI that, launched that gas development project just earlier this year. I think it was January. So, does that hold well for perhaps more gas exploration? And are they, looking to lease out blocks?
Well, they've already leased. They bought from BP. There's this one fantastic place, which is the Gulf of Sirte. It's 4 BP blocks under which they've done this 3D seismic survey, and the indication is that there's tremendous amounts of gas there. It's like the Zohr field off Egypt, but nobody's ever sunk a drill bore. Now, BP basically pulled out of Libya in 2013, and then they agreed to sell. I'm not sure how they structured it, but they gave basically half of their concession to ENI. And ENI said at the time, we're going to go in. And that will be the bellwether. If you want to watch one thing in Libya, watch ENI, because ENI are really, they know Libya backwards and they really have a handle on it. And they are, that's how you really test the temperature. And the temperature will be, are they going to go into the Gulf of Suez and also Ghadames, the big oil field in the southwest? But at the moment, they're not doing it. They're not commenting. They're not saying why we're not doing it or why we don't do it. But that's going to be really the weather vane for all the other companies.
Excellent, excellent. So Maleeha is still having problems logging on. I'm trying to work on that in the back end. So we'll go back to Andre quickly and talk some more about the Black Sea. So I wonder.
Yeah,
I don't know.
sorry, Tracy, let me just interrupt you because around 5 minutes ago, Chicago wheat hit limits up because of more Russian news. So actually now it's in, and now it's a bit lower, but I was saying it's plus 60 cents this session.
Wow. So I heard, I'm not sure if this is true or not, but apparently Turkish officials have reported that they've notified the Ukrainian government that they're not going to provide escorts and or protection for commercial ships that are attempting to export grain from the ports on the Black Sea due to risks associated with escalation with Russia. Well, one, is this true? And two, in that case, are there any other routes that can be taken?
Yeah, so I haven't heard official statements from Turkey about that. We heard some statements, semi-official from Kyiv, that they expect Turkey to provide those convoys, those military vessels to accompany vessels going to Odessa. But it seemed more wishful thinking from Kyiv. Because Turkey and NATO country probably. I don't see a reason for Turkey to do that, especially taking into account that it's not a country. So, in our view, it wasn't on the cards. And this week, President Zelensky sent an official inquiry to Istanbul, and he went to Turkey a few weeks ago, I think, asking about that. But we haven't heard any official statements from Turkey, and I think that they won't provide such coverage. And I don't see a lot of reasons for them to do that. But fortunately for Ukraine, they have other ways to export their grain, other routes, not only Odessa or Nikolaev terminals. So there are terminals at the Danube River. They actually were almost forgotten before the war, but after the war, they became a very important route for Ukrainian grain. And they have been developing them extensively in recent, actually since the previous year, building railroad infrastructure, making digging the river floor so they could load big vessels. And just a few weeks ago, and actually yesterday, they for the first time loaded a relatively big vessel, handy size, around 20,000 tons of corn and barley, and that was the first time. And actually now, and it has been the main route in recent months, and now it will be the main route for Ukrainian grain. On top of that, they still, with some problems because of political tensions with Eastern European countries, they still can ship via land, via Eastern European countries, first of all, like Romania, also Hungary, Poland, and their neighbors. So if we look at export capacity of all those routes, actually they can ship now, probably in the new season, up to 40 million tons of grain, which is actually close to the export potential in the new season. So if so Odessa, it's not, I mean, we understand how market works and how it reacts to recent news and how it reacts just news that we're out right now. But in reality, Odessa shipments are not so important as you might think if you listen to politicians, if you listen to Kyiv, because even without Odessa, they can ship almost everything they have in the new season.
And then also had a question, what, is this also going to affect the fertilizer market? And if so, to what extent, if any?
No. Ammonia pipeline, yes, Russia has been talking about it for many, many months. It has been reopened. It has been damaged. We don't know if it can be recovered. It's, again, another mystery of this war, similar to gas pipeline. So no, it's current events most likely are not important and won't have any noticeable impact on Russian fertilizer exports. Russia has its own agenda now, and they're trying to build a new terminal in Russia, in Taman, Black Sea, Russian Black Sea, and they say that they expect to launch it this year. I'm not sure about this year, but probably next year. I think it's quite likely that, taking account that the Kremlin pays a lot of attention to this ammonia exports, it could be quite likely to be launched early next year.
And then also I had a question. So several of the surrounding nations in Europe have actually like doubled down on their efforts to keep Ukrainian supply out of their local markets. And so how has this impacted Ukraine? And if so, does that mean that they have to take longer routes to put it somewhere else? And who is the beneficiary of this?
Beneficiary of what?
The grain that's not going to say, I know like I think Turkey and Poland and a couple other countries have not wanted Ukraine's grain in their local markets to compete with their farmers. So instead of going to those countries that it was, who is getting that? And are they sending it to Africa, or where is that going?
So about destinations, we can talk briefly. I don't think, probably they could change, but not really substantially. So the main destinations for Ukrainian grain were, first of all, the EU, Spain, Italy, the Netherlands, then China, and then Turkey. Those were the major ones. I don't think that things would substantially change after the end of the grain agreement. And yeah, so, and you mentioned that Eastern European countries doubled down to help Ukrainian grain flow. This is not correct. This is very far from reality, because in fact, the Ukrainian countries, it all started with Poland. They were very annoyed because of flow of Ukrainian grain, because the EU protects its market, and so Ukraine couldn't ship its grain before the war to the EU. Then last year they lifted import barriers and allowed Ukraine to ship grain to the EU directly. And at the end of the day, many Eastern European farmers, when they saw $250 per ton wheat prices last year, they hoped to see even higher prices later, and they sat for too long on their own stocks. And on top of that, it was a lot of Ukrainian grain going into Poland, Hungary, Romania. So indeed, stocks were huge. And Polish ruling party has election coming, and they need to boost their ratings. And they decided to actually, without even warning Brussels, at least officially, they just banned imports of banned imports from Ukraine, and it didn't look well because one day President Duda and President Zelensky were meeting in Poland and shaking hands, and almost the next week Poland banned all Ukrainian shipments, and other countries followed Poland, like Hungary, Romania. And actually, Brussels told them not to do that, but they insisted. And at the end of the day, they made some kind of agreement that until mid-September, Ukraine will be able to ship its grain via their territory, but won't be able to sell its grain directly in those countries. And actually doesn't look good because Brussels looks weak in this case, because the EU, the agriculture policy, trade policy should be common, but here's a clear exception, which has been done for Poland and other countries. And Kyiv says that the EU told Ukrainian authorities that those restrictions will be lifted in mid-September, but just, I think, a few days ago, again, those countries said, no, we don't want Ukrainian grain, and we want to extend that restriction beyond mid-September. So in reality, it's not so idealistic. So they might say a lot of things, but when they want to protect their market for political reasons, they do protect them.
So how is this overall? Well, first, do we know how long this is going to last? And what are kind of the other options right now? Or is this grain just stuck in Ukraine?
As I said, so, just to question what will happen to Ukrainian grain. First of all, they don't have huge stocks contrary to early 2022. Because of the grain initiative and because they sold more than 30 million tons out of Odessa terminals, and because their last year crop was smaller and this year crop will be even smaller, so they don't have a lot of stocks, a lot of supply to deal with in the current season. And as I said, they still have the Danube terminals, and most likely they will still be able to sell their grain via the EU, via Eastern European countries. So it's not really such a big issue for Ukraine, and it's not really such a big issue, to tell the truth, for the global grain supply and demand, because Ukrainian grain still will be reaching the global market. I mean, for how long this rally will last, it's hard to say, especially looking that we're still almost near the limit up. But obviously, the market just needs to realize that story a bit inflated, first of all, and also the funds probably would need to cover all their wheat shots, similar to what they were doing with corn just now. And so I don't know how long it will last. Probably, I think, at least a few sessions. And if we talk about Chicago, probably we'll see at least new highs somewhere close to $8 per bushel. I won't be surprised to see those price levels.
I know some people that are long wheat that would like that. So how does it, speaking of, since you brought up Chicago and France, how is just, can you give us just a brief kind of overall glimpse of the global market right now as far as wheat is concerned?
Yeah, so now what we face right now, it's called weather market. So there are a lot of things. So a lot of things in addition to the Black Sea story. So so we know there is a good. So I'll talk about wheat and corn because they're closely related. We know we have a good crop in Southern America, but not a good crop in Argentina, obviously, but a very good crop in Brazil. But there are infrastructure bottlenecks for Brazil. There is still a lot of debate about the US corn crop. The market still thinks that current numbers USDA uses are a bit optimistic. And right now, again, talking about the weather, right now it's becoming a bit too dry for new corn and also soybeans in the US, which is a problem. If we talk about wheat, there are some problems with probably with US, with North American spring wheat. Canada mainly grows spring wheat. US, around 30% of US wheat is spring wheat, and it's too dry, and it's too hot in the US, and that's a problem for spring wheat in Northern America. Then we had some problems in China with a new crop. Again, it was recently it was too hot for new corn crop. Before that, it was too wet for the wheat crop, and its quality suffered a lot. If we talk about the EU, actually, it's no problem, no big problem there. If we talk about wheat production, Ukraine production is likely to be substantially lower than the last year, but still they have quite a good export potential, taking account that we're talking about the country which faces a war, around 10 million tons of wheat, compared to 17 million tons a year ago, and probably around 20, 25 million tons of corn to be sold in the new season. And if we talk about Russia, it's likely to face substantial decline in wheat production. We're just updating our new forecast. Probably last year it was a record high crop, 104 million tons. This year, roughly minus 18 million tons compared to the previous year. But at the same time, it's still a good crop first, and there are huge carrying stocks in Russia. So actually, total supply of wheat in Russia is close to the previous record crop year. So Russia is aggressively selling wheat right now, and has been aggressively selling wheat right now in recent weeks. And we expect to see a record pace of Russian exports near term, and actually in the whole new season. And the major bottleneck would be not the wheat availability inside the country, but the infrastructure bottlenecks.
So that's a basic overview. All right, we'll come back to you. Let's go back to the energy markets very quickly here with Chris. Leah's still having a few problems. So I think, Chris, what are some other hot spots do you think that we should be watching about or worried about as far as production or geopolitical, risk factors in the energy markets?
Yeah, well, I wanted to say, with reference to your last speaker, how the Russian invasion has it's like a stone in a pond. It's got these ripples that go out and out and out, and it's made risk management on all sorts of things, and including oil and gas, so much more difficult. Because, for instance, Europe now wants to decouple from Russia, and so suddenly everybody in the Mediterranean who's got gas and oil fields has a whole new opportunity. And Algeria, for instance, is an enormous winner. That they had all these problems, and now all these problems are going away. And Libya, suddenly everybody wants their oil and their gas, and they want security to make it done. The East Med, Cyprus, Israel, and Egypt have been wondering what to do with their gas. Now they know, and it has some sympathy, I think, for anybody who's into quantitative risk analysis, because they've got this unknown. They don't know how deep the sanctions are going to be and how long they're going to last and what's going to happen. But I think to watch is basically the entire Mediterranean oil and gas. How are they going to take advantage of this? Can they take advantage? But also, what are the political problems? Because in Libya, for instance, the government's very fragile. And what this shutdown showed is, despite the government having all this money and spending all this money, they're really frightened of any kind of opposition from any faction. That they gave way on this detention within a day. They didn't try and stop it or try to hold out or anything. And I think that's going to lead to more problems in the future. I'm not sure that really helps.
No, it's good. No, I mean, it's very good point about the ripple effects that this is all having across all the commodities, actually, as well as other things.
I mean, one thing I'd like to say is, I mean, everything is short term. I think if you're investing, if you can make money fairly quickly, then great. But if you're looking long term, then that's just a massive question mark.
Yeah, It is the ringer. And then I wanted to ask your opinion. So, the U.S. military just announced it was bolstering forces in the Persian Gulf to counter the Iranian attempts to seize oil tankers in the region. I think they just sent USS Thomas Hudner and some F-35s and some F-16 fighter jets to the Central Command area of responsibility in the region. Is this just, do you think this is just Iran being Iran? Every couple of months they get uppity and seize a few tankers? Or do you think it's more serious this time because the U.S. government's kind of finally reacting?
Well, I think it's Iran being impatient because they thought under the Obama administration that everything was going to open up and they were going to sell this massive amount of oil and gas, and that didn't happen. Trump cancelled it. Biden hasn't, they thought Biden would open the gates, and he didn't. So they're getting impatient. They're getting restless. If you look at people like Total, they spent like, I don't know, $1 billion or something on these gas fields, and they just pulled out because they didn't want to be sanctioned for their US assets. So Iran is kind of chafing at the bit. But the other thing to watch is Gulf politics, because there was basically a Gulf Cold War going on until about a year ago. You had Saudi, UAE, and Egypt on one side, Qatar, Turkey on the other, Qatar, Turkey being sympathetic to Iran. And it got so bad, as you probably remember, there was this air embargo of Qatar. Now that ended when basically Biden came into power. Saudi and UAE lifted the air embargo. And since then, there's been this, everyone's being nice to everyone. It's extraordinary to watch. But I'm not sure how long that's going to last, because the tensions between the two sides are still there, and Iran is still this sort of outlier. And I think Iran wants to see some sort of concessions, and it's not getting them. And I think the Americans have decided to play hardball. Actually, I mean, I think it's the same with Russia. Really, they thought, well, we've got to kind of push the world order. We don't. Russia-Ukraine invasion is one thing, but if we show we're tough there, then China won't want to mess around with Taiwan, at least in theory. If we send ships to the Persian Gulf, maybe that will tie off Iran. So I think they're playing hardball, and I think there'll be more of that.
Basically the same dangers kind of exist, the same geopolitical areas. We're still kind of still up in the air, even though things are kind of calm right now. Is that basically it?
Yeah, and if you look at particularly Qatar, Emirates, Saudi, can they all get what they want and get along? Because a lot of them think they can. Think, well, this standoff was actually kind of pointless. But Iran is the big unknown. If Iran causes trouble, then what? How are they going to respond to that? And then there's the pressure. Well, should they then push for Iran to be let back into the world markets and oil and gas markets and be able to import things, despite the fact that they might be building nuclear capacity? So I think that's where the uncertainty comes. And I think just to watch it really, because also to do with Libya and Egypt, the more the Gulf powers confront each other, the more unstable Libya gets, because they all have proxies. But the more the Gulf powers get along, the more the proxies get along.
Excellent. And I see Maleeha finally made it up here. Are you there?
Hi, Tracy. I'm so sorry about that. Yes, I'm here.
No worries. All right. So we've been talking to Andre about agriculture and Chris about energy. So we'll continue with the energy markets, and we'll have you join the conversation here.
Perfect.
So let's talk about oil a little bit. You've kind of been a bear for quite some time. So can you kind of walk us through the macro reasons why you kind of have this view of the market?
Sure. Thank you so much for having me on. In terms of the oil market demand supply, I think the macro has confounded the bottoms up players, because since last year, when the oil market, we've always maintained the thesis that there has been no shortage of oil. Last year, we had a confluence of three factors, where we had a very cold winter, then we had the Russian war, and then obviously we had an OPEC that was very slow to bring production back online. That's what helped exacerbate the price surge. But now, today, we're in an environment where the U.S. Federal Reserve has an ambitious plan to get inflation down to 2%, and across all of 25 macro quantitative indicators, we're seeing tightening. tightening of liquidity, tightening of supply, tightening of lending banks. So the economy is slowing down, and we see this across ISM, PMI. And the biggest demand is that most people assume demand supply balances are going to be in a deficit, but it's the macro demand that's changing dynamically, and that's what's holding oil prices back. If it wasn't for Saudi right now, we would see prices much lower than even 60. Having said that, so if you look at forward 3 month cross asset indicators, the economy is slowing down. We talk about gasoline demand, and that's decent right now because of summer driving season. But then if you look at manufacturing or distillate or diesel, industrial slowdown, that is actually really pulling the weight down. And then the other bullish point was on back of China reopening. China has reopened, and we saw them surge in the beginning of this year, which helped by the liquidity they put in. But China is still taking a lot of oil and shoring it on store, and they have their travel has gone back to pre-COVID highs. But yet we are weak because there's so many other variables in the oil market that are actually weakening. So the demand supply on our metrics is actually showing a shortfall of demand. The biggest play on oil right now, we feel when prices could rise, if you think demand's going to recover, and that's a big debate in the market right now. Is demand going to pick up for oil, and can it happen when the U.S. central bank, other banks are tightening liquidity by raising interest rates and creating a very tight system? And that is the big debate right now.
And then since you brought up the Federal Reserve, do you think, how many hikes do you think that we have left, and how, if any, have these hikes that we've had so far, the steepest rate ever in history, just about, have these hikes even started impacting the commodity markets in general? I mean, have they filtered in yet?
Absolutely. So it takes about 6 to 8 months for any interest rate hikes to be felt in any economy or system. So we always say the Fed always over eases and they over tighten. It's like a big ship. When you steer to the left, it takes a big move to see like a result. You don't see the Fed has over tightened right now and they can't see it, but they cannot stop right now because until they see that headline print of 2%, they cannot stop. Unlike we go back to the 1970s where we had inflation going up. So in our opinion, they've over tightened. We can see this distress in all the industrial good prices and economic indicators. And I think on back of that, so the Fed probably has one more hike left, 25 basis points, but that's not the point. The point is that they should probably stop right now, and they cannot, because if they do, commodities are going to rally, inflation is going to pretty much is going to go out of sync here. And so, yes, there's absolute weakness in the economy right now, and as usual, the Fed's going to over tighten until something snaps. We're seeing distress in the commercial real estate market, the debt market, for instance, in real estate. So the economy is slowing down. And the Fed, the only way to help this market, because we have a massive debt problem, is to print more. But if you print more today or you cut interest rates, the market will fly, inflation will probably go north of 10%. So there's a bit of a dilemma, and there's a time lag. The reason why we rallied so much in 2021 was because they eased so aggressively that, obviously we saw a massive rise in prices, but now they've over tightened effectively.
So that's good news.
That's good news, but until something snaps, they won't stop because their indicators are still showing pretty high inflation metrics. So when the Fed's looking in the backward mirror, and I guess what's happening is they should be more preemptive rather than reactive. And going back the last 15 years, they created this system where every time we get an economic hiccup, the only thing they can do is to print more money. The US Fed balance sheet today is trading close to $9 trillion, but yet they haven't normalized. They cannot. Every time they try to, something blows up. There's so much debt in the system. So the issue is, you're absolutely right. If the Fed comes out today and starts stimulating, or China starts stimulating, it'll be probably the wrong thing to do, and oil will fly. But until then, there's massive economic weakness, and that's why the demand numbers are still weak in oil. And as I mentioned, if it wasn't for Saudi OPEC plus, right, obviously they took a lot of oil off the market and they're cutting right now, but there's a lot more supply too. So demand's falling short, supply is picking up from Iran, Venezuela, others are, in fact, U.S. domestic shales doing better. So this is offsetting that. The big question is, how long will Saudi be able to hold the price of oil when they actually start getting annoyed at everybody else overproducing? And I think that's another big issue in the market.
And then what do you think, what are your thoughts on China? And obviously the open was not as robust as everybody had anticipated. Obviously the sector the property sector has been a disaster. And
Correct.
so why do you think they've been so slow to kind of stimulate the economy? I mean, they've done a little bit, but nowhere near what they have done in the past.
Right. So China's economy hasn't really decoupled. It needs the rest of the world as much as its domestic consumption. So if you take a step back, post the reopening, China obviously injected a lot of liquidity in Jan and Feb this year, and we saw a massive surge in prices. But once again, it has a balance sheet issue. Its debt to GDP is way too high. Every time it prints trillions of dollars, we just fizzle back down. Until the rest of the world, US and European, the export data demand picks up, they can't keep stimulating because the debt situation will get worse. So yes, it's a massive property secular issue, but China's focus right now is not to get infrastructure up. They use infrastructure as a means to get GDP up, but they want to focus on the actual domestic demand, consumer. So all the stimulus that the market talks about, which is the only hope left in the market, is all based on that China is going to do what it's done in the past. Not really. Its focus is very different right now, and demand. So if the export market to Germany or Europe or US is weak, how is it going to grow? So the China demand has not been weak. It's actually been taking a lot of oil and storing very strategically. Even prior to the reopening, it's very comfortable. The global inventories are actually really comfortable, and China is very smart. They buy low and they sell high. So this reopening trade really doesn't need to be played out because China has already reopened. So how much more can they demand effectively? The problem is with the rest of the world, EU, OECD, Europe. That's where the demand issue comes in.
Right. And we have seen, after the energy crisis, we have seen kind of a deindustrialization of Europe, right? Where,
Absolutely.
a lot of their manufacturing is shut down, probably won't come back, as far as, we saw, we have BASF that's moving to China. We have Volkswagen that's, opening the battery plant in Canada instead of Europe. And so what does that kind of outlook look like just in general for, not only energy markets, but metal markets as well?
I think that really points to the whole higher for longer secular inflation. So right now we're going through a deflationary phase where basically, obviously, input prices are coming down, but we have changed. There's been a paradigm shift in supply chains, input costs, moving industries offshore and onshore. I'm sorry. So all that's going to lead to a higher for longer terminal rate of inflation, which we know that back about 10, 15 years ago, inflation rates were probably like around 4%, 5%. So this is the new norm world. We're so used to an environment where we had 0% rates that nobody knows how to function in a world where we have 5% normalized rates. But in a system that's so tight and so levered at this debt level, if you keep 5% for the next 6 months, something will snap because the economy cannot function. Every dollar they're printing, less and less economic productivity happens. And this is a dilemma that we faced for the last 15 years. So it is an amazing dynamic, right? We can call up, is there one more sort of kicking the can down the road? But eventually, when will this experiment fail? But right now, the Fed and central banks are really torn between using their own measures to boost that versus inflation. Inflation is a huge issue for them. And like I said, even the goods prices are down, services inflation, the actual grocery prices, the real wage growth, that's an issue for the Fed. So they cannot pause right now. And the only way they can actually cut rates is if they break something. And I think in some sort of way, the Fed is actually trying to burst this excess liquidity bubble. And the market right now is actually of this hope that second half recovery, we see a soft landing. It's impossible. We had the most aggressive rate rising campaign in the history of financial markets, and you expect to go with no hiccup. And I'll leave you with an anecdote because 2007, when we saw the first crisis in July '07, it took 15 months before Lehman's went bust. So this game is not over, right? So we've rallied on back of technology stocks and the market's rallying, but the underlying weakness in the economy is really quite dire. And I think that's something that needs to be absorbed by the equity analysts and people out there, because if you're investing in the large 7 tech names, that's fine. They're doing really well, but other sectors are not doing well.
Thank you very much for that. And I know that you just joined us, but we're coming up on the hour, and I don't want to take too much of everybody's time here. So I kind of wanted to do the final round. And the final round is the same question for everybody. Really, talk about something that we haven't discussed yet, or what should we as investors be looking at or should be paying close attention to over, say, the next 12 to 24 months? And we'll start with Andre.
So yeah, we cover Black Sea. So the war here will be an important factor for the grain markets and for oil markets as well. For the grain market, first of all, because we know that Chicago trades all news coming from here as wheat news, whether it's bullish or bearish. Unfortunately, we don't see that this conflict will be over soon. And, there are some optimistic estimates that it could be a big Ukrainian counteroffensive. It will be successful and will be over soon. No, it doesn't look that way. It looks like a long conflict which could shake the market many times, I think, during the next half year or even more.
Thank you very much. And Chris, same with you. What should we be, what should we be really paying close attention to kind of as investors in this area, over say the next 12 to 24 months? Or you can talk about something that we didn't get a chance to discuss.
No, I think you discussed all sorts of things. I would say the two things to watch for Libya. If you want to watch Libya, watch Total and ENI. Don't worry about what the Libyan NOCs say. Watch to see what they do. They're the bellwethers, especially ENI. For oil and gas, is the EU serious? Okay, they say they're going to decouple by 2/3 the amount of Russian gas, and I've forgotten how much oil, but it's about half or more than half. Because if they're serious, then there's a huge new market, and it changes the whole paradigm. For the Gulf, to see if Saudi and Qatar are still friends. If they're still friends, that's going to be security. But also, where does Iran fit into that? Is Iran fed up that Qatar was supposed to be helping it and Qatar's lost interest? How far will Iran push it to get the sanctions lifted?
Thank you. And Maleeha, and I will definitely have you on again so that you get a chance to get an opportunity
Absolutely.
to speak some more. But, we will definitely get you on again soon. So
Thank you.
don't worry about that. But your final thoughts, what you want to leave for investors to be thinking about going forward for, the next 12 to 24 months.
Sure. With regards to the energy market, I think investors should keep an eye on Russian volumes. If they actually do keep up with the promise of lowering their volumes and we have a tighter supply, I think that can help oil prices. Until we see demand pick up and supplies fall short, we won't see oil prices rally. From a bigger perspective, the dollar. The dollar is the key to every single asset allocation right now against the yuan, against the yen, and people sort of don't realize the bond market uninverting the spreads and the dollar. That distress is going to filter into all asset classes. So I think we need to keep an eye on the dollar right now.
All right, all good things. So I want to once again thank you to all the speakers today for taking time out of your day to come and share your wealth of knowledge with us. Thank you to all the listeners. Please do follow all of these people. They have excellent streams and post a lot of really good information. Of course, follow Place Your Trades so you can find out what else that we have going on, we have a ton of stuff going on. In addition, don't forget to sign up for my weekly blog and daily morning posts. And then again, I put a link to the PDF for the key takeaways this week. It's up in the nest, but it's also in my Twitter stream. So go there, sign up for that, and it'll get delivered to you tomorrow. And with that, I want to again thank you, everybody, and we will see you next Wednesday. Thank you, everyone.
Thank you.